So what are the Keltner channels and how do you use them to better your trading? Hey, how's it going? On this channel, you will learn the steps it takes to make a full-time income trading in the stock market. And today, we're talking about the Keltner Channels indicator on Thinkorswim. So the Keltner Channels is an indicator that uses a moving average and an ATR combined. And if you don't know what an ATR is, I would definitely go look that up. Otherwise, this indicator might be a little more confusing if you don't know what that is. But basically, it takes the volatility of a stock into account. How this indicator works is it has three lines here. It has the moving average. So for on this chart right now, this is a 21 simple moving average. And so that's all this teal line is it's just the moving average on the chart. But then what the channels are is these dotted lines on the other side of the EMA. So essentially that's the ATR part of the indicator. And so for the channels here, you have an ATR or a top part of the channel and then a lower part of the channel. They get small when there is low volatility in the market, and then when volatility increases, they can get really wide. And the idea is that these could be potentially support or resistance levels based on how the chart is. And some people say that if it's above the channel, that means that it's overbought, and then if it's below the channel, that's saying that it's oversold. But just based on this chart right here, that definitely doesn't mean you should be buying when it is below the channel, because just based on looking at the stock market right here on a daily chart, you can see that as it goes below this channel here, that it still sells off really hard. So don't use this indicator just blindly to buy if it's below the channel and to sell if it's above the channel. Now, generally to set this up, you want to use a moving average that you normally use. And so for here, I have the 21 moving average. And for the channels, it is a simpler moving average. And actually with these channels, I think the best way to use this indicator is just a way to keep you grounded and realize if the stock is oversold or overbought, because these channels give you more of an indicator on how far away from the EMA the stock really is in terms of volatility. Because a stock is always going to at some point return to the moving average, you want to know, oh, am I too far away from the moving average to be essentially buying the stock or selling the stock? A moving average is like gravity. The further and further away a stock gets from the moving average, the more likelihood it is going to bounce back to the moving average. It always wants to keep tapping the moving average, even in a uptrend, downtrend, or sideways trend. It'll always be tapping the moving average, and just the further and further away it gets from the moving average, the more likelihood it is to return. So when you see something like this, when the market is so far from the moving average and you get the urge to want to sell or short the market in this area, it is probably not a good idea, because you can see that the moving average is all the way up here. It's more likely that we are going to return to the moving average. Now, that doesn't mean you're not going to keep going down, but it just makes it more likely that you are going to have a bounce sooner than later. With these channels, I think it's actually a great thing to do is add multiple channels. So what you can do, another chart I have here is, again, this is the stock market on a daily chart, or the S&P 500, and you can add more and more channels. And so each of these dotted lines, as you go further and further out, it increases the ATR setting. So this line right here would be 1 ATR away from the mean. This would be 2, 3, and then all the way up to 5. And these are essentially severity levels of how far the market will go away from the mean until it really gets a bounce. Quite often, especially in this volatile market, you will get the market or just stocks that will oscillate between the 1 to 2 ATR range and even 3 ATR range pretty regularly. So they will oscillate between these three channels here. This is why you don't want to necessarily be, oh, it's come, this far away from the mean, I should short it because it's more likely it's going to go back to the mean. Just because it's X far away from the mean doesn't mean that the stock isn't going to keep going that direction. But this indicator is great for keeping you on the right side of a trade. And you can see here, most of the time when it breaks through these more two solid lines I have right here, which is the 4 ATR and the 5 ATR, this here is really far away from the EMA. And generally that is a good support level. Now, you can see that even though it did hit this 5 ATR here, the stock did bounce back briefly here, but then it did begin to sell off again and keep tapping along this support level here and then eventually bounce. So again, I just want to reiterate, do not just trade based on where it is in the ATR levels. You want to be using this with another setup. Now, to quickly show you how to set this indicator up like I have it, here is the study. And so you have to add the study 4 times or 5 times for however many channels you want. And then all it is you want to change the length here of your EMA or SMA to whatever you want to use. And then the factor here, that is the ATR. So this one is the 1 ATR. And then if you wanted the 2 ATR channel, that would be you would just put a 2 right here, then 3, then 4, then 5. And then also if you wanted to use a exponential versus a simple, you could do that, or any other kind of moving average, you can set that there. And then just to change the bands and colors however you want, that's just down here, 2 different line styles. And so it's a little tedious to quickly set up, but once you have it set up, you can just slap it on a chart and see kind of where you're trading. Now, as a trading example, let's look at Apple right here and kind of see how a trade works, or how you could use this as an example of where you could take profits or where you could use it to stay in a trade and keep going. Now, so this is a 78-minute chart of Apple, and I'm gonna zoom in right here on this pretty good looking squeeze setup that we had. Now, if you don't know what the squeeze is, I will link to a video on that. But so the squeeze right here is essentially a continuation indicator. And so we are in an upward trend right here, and we got a little bit of a spike here, and you can see that as soon as the stock kind of hit this 4 ATR area or was poking into the 5 ATR range, it pretty much put a cap on the market. And so the stock would just kind of butt into this area. Now it would trend up a little bit here, but it won't be as much risk to reward ratio. If you more buy at the EMA here, you have a lot more upside room and potential. And then once you're kind of in this 5 ATR range or 4 ATR range or even 3 ATR range, you really are risking a lot more than the potential for you to make. Now, that doesn't mean that if you hold it for a longer period of time that the stock isn't going to consolidate and then keep going up, but you just want to keep in mind that the easy money is gone and maybe you should take profits or take some profits. So looking at this squeeze, this was a pretty nice squeeze setup. There was really strong consolidation here, and so the idea is you would be wanting to buy in this EMA area where these red dots are, and then look for upward price movement. And so that's what we got here. And the stock did a nice job of just trending straight up pretty much into this 5 and 6 ATR range. And once it hit this area, it kind of put a cap on the market. It kind of it took quite a while for it to break this. Now, because this is a shorter time frame chart, the EMA is going to catch up a lot quicker. And so it really only took a couple days for it to recover. Zooming in on that, it kind of started to come back into and actually here it dipped all the way back and touched the EMA. And so once it kind of got into this 4 to 5 ATR, it wanted to come back to even the 1 or 2 ATR range before it started to go up. Now, for the overall price movement, the stock really didn't come down that much except for this quick little sell-off and then recovery that it had right here. But for the ATR, because the overall price really kind of stayed the same, but the EMA was able to catch up here, that allowed the ATRs or the Keltner channels and these upward bands to move higher, essentially creating more of that upward potential and that area for the stock to keep moving up before it hit those upper bands again and really kind of needs to come back to the EMA. And so you can see as it then starts to break out again, goes up, it hits to this 4 to 5 ATR range and then immediately comes back to the EMA once it hits that area. And so even though it kind of hit the 4 to 5 range here, it doesn't necessarily mean that it's then going to just immediately sell off. All it means is that the stock needs to kind of reset. It needs to come back to the EMA here, and then it can allow it to keep going up. And then once it hits it again, it might need to consolidate again. And so this can be good spots to take profits. So once you get, potentially getting the trade down here, you see that it kind of, the easy money is good and done. And so you're going to want to take profits here. And you can see actually that over here on the right, this is kind of the old highs. And so that would be really good selling point at these old highs here. And then also when the channels kind of show that you were really far away from the EMA, and then you're probably going to get resistance here. And so just moving on in this uptrend, you can see how Apple here kind of oscillates between these bands, but it never really breaks out of them. And when it gets extremes or to the extremes, it's always going to want to come back to the EMA. And so this can be a really good way to keep yourself contained and not getting too greedy by wanting to chase huge breakouts like this, or trying to sell at the bottom when the stock really sells off against you. Even when you can see that there's earnings here, that the stock erupts here and really hits the upper bands and kind of breaks through, that really again puts a big cap on the market, and it decides to sell off from there and come back to the older levels. Now you can see that right here is essentially the old highs from right here, and then it's kind of down at the 1 ATR in it, so it holds that 1 ATR as support. And so I would say this is a great way to use this indicator, is use it in conjunction with something else. So you want to use it as a way to understand where I am or where the market is. And is the market really oversold or overbought when it's at extremes? And use that to not necessarily, oh, I see it's at extremes, I'm going to short it. More use it as, oh, it's at extremes, I should probably take profits. Or it's, oh, it's at extremes down here, I should probably try and hold on a little longer to try and get a little better of a selling point. Because if you try and sell at these extremes, if you tried to short right here at these extremes, you could see that it did come down a tiny bit, but overall it would not have been a good trade. And so this is why oversold and overbought indicators really don't work by themselves, because in an upward trending market, you don't really get overbought indicators. Because it's an upwards trend, things are going to show that they're overbought a lot because, well, it's an upward market. Everyone's buying. Just because an indicator is telling you that it's overbought does not mean you should short it. And it's the same flip side for if something says it's oversold in a downtrending market. You always want to be trying to stay with the trend, because life is going to be so much easier trading when you do. Trying to counter trend, you can find spots like this where it's at an extreme and you want to counter trend trade because a short might be great. You could have something like this happen where you just pick the top and feel amazing and get a great sell-off. But you could also just as easily find something like this where you short the market and the market just kind of goes sideways and then goes straight up and you lose your trade. And that is more likely in an upward trend that the market is going to do that. And so trying to counter trend trade can be really dangerous, and I would definitely not recommend it. Always try and trade with the trend, because it's going to increase your winning chance just because you're trading with the trend. You can have bad setups and bad entries, and they can still work out just because the trend is in your favor. Hey, so thanks for checking out this video. If you want to learn more about stocks and trading stocks in general, and maybe more about that squeeze indicator, make sure to subscribe to the channel. and I will definitely answer any questions you have in the comments below. Don't hesitate to ask them, and I hope to see you in the next video.